Use the method I'm about to use, you get the best of both worlds. But let me stop ranting and raving and let's talk about number 4. I really like number 4 because when you go get a 30-year loan, you've got a lower payment, and that's nice if money's tight. If you would have gotten a 15-year loan, you'd have a higher monthly payment, but not a lot higher, but that'd still be your minimum payment, right? But when you use the method I'm about to use, you get the best of both worlds. You have a 30-year fixed loan, which means your payment is pretty much as low as it can be, but you can pay it off in 15 years by just adding a certain amount of money, not double the money, but just a certain amount more. You pay it off in 15 years. Now, if you had a problem where you couldn't make those higher payments for a few months, that's fine. You can go back to the minimum payment, then come back up to the higher payment when you're ready. So you've got that flexibility between 30 and 15-year payoff time, but you can pay it off early if you want. How much do you need to add to pay off this 30-year loan in 15 years? We kind of already know because the last thing we just did, the extra quarterly payment, pretty much resulted in paying it off in 15 years. We just need to slightly tweak that to get exactly 15 years. And it turns out that number is $1,170. You pay it off almost exactly in 15 years. So if you artificially add $1,170 to each payment, you'll pay it off in half the time, saving almost $390,000 in interest. OMG. I love that. And of course, the key advantage, if life goes wrong and you can't handle these higher payments, you can always drop down to your minimum, $3,300 a month, and then come back to the higher payoff rate if you want, and catch back up with the timing to still pay it off in half the time.